to start this class, talk about options, how to pick the right option contract, and how to identify the geeks. So options are the security vehicles used to participate in the stock market to gain or protect an asset. An option is unlike traditional stock ownership. As an option is not a physical stock ownership like a stock certificate would have. Options are contracts with exchanges that have these stock certificates. They enter into an agreement with you for a specific amount of contracts and a date of fulfillment to either deliver on this agreement or forfeit the agreement. When you purchase a contract, you have the right to exercise that agreement, but you're not obligated to execute that agreement. For example, if you believe that Apple will increase in value over the next 6 months, you can purchase a contract for the right to buy 100 shares of Apple. In 6 months period of time for a specific price, usually the ask, that's the price that you buy it for. It is typically 1/4 of the cost of owning 100 shares would cost. This is called the strike price. The strike price can be either the price it is now or a future price you anticipate the shares to be. The difference of the strike prices will affect the cost of a contract. You can sell the contract back to the market at any time. The closer your strike price is to the current price, the more value the contract will hold. Okay. Now let's see the contracts here. Put it on the screen. Okay. Go option chain. Okay, this is how we'll look. So over here, on this side, we got calls. And this side, we got puts. Right here is the contract date, where it's going to expire. So you can have it more. Usually says here, but if you have it open, it says here. All these are October 18. This is the strike price. So there's another thing. When you sell a contract, you have the obligation to exercise that agreement, but you're not the right to execute that agreement. For example, if you believe that Apple will decrease in value over the next 6 months, you can sell a contract for the right to sell 100 shares Apple in a 6-month period of time for a specific price, typically 1/4 the cost, selling 100 shares with cost. This is called the strike price. The strike price can be either the price it is now or a future price you anticipate the shares to be. The difference of the strike prices will affect the cost of your contract. You can try purchase the contract back at any time. The closer your strike price is to the current price, the more value will hold. That's for another topic. Will we be focusing on only buying options in a directional manner? So the ask, what's the ask? It's right here. This is the price. The ask section of your options table tells you what the current market is willing to sell the specific strike price option listed. This is the current market price at the current moment. So if you want to buy, this is the price that you're going to get at the ask. This is the price they're selling it. The bid section is this one right here. If your options table tells you what the current market is willing to buy the specific strike price options. The bid is typically always smaller than the ask. And there is a spread that you need to be aware of that when you're buying options. When there is a big spread of options, well, you're gonna be on a bad situation right there. You're gonna make sure that the spread is not too big, so you get filled right in the middle on a good price. If you have a big spread, that's not good on options. Just keep in mind, because you can be filled at a lower price and you want to sell back. It's going to be, even if the stock goes higher, still a huge spread, and you got to meet that the bid price, and you're going to be losing money in that. So make sure the spread is not too far from the ask. Like I said, this one 24, 25, that's good. There's no spread there. So usually stocks with high liquidity, like SPY, Facebook, Apple, all those that are highly traded, they have a small spread. So Vega section, the Vega is I will have it up here. I think I don't have it right here. Let me put it on. What is the option? So I can put Vega. Okay. This is the Vega. So Vega section of your options table tells you what the current volatility effect your option has. So it means the volatility can move this option price either up or down by this amount. We can not only we cannot really control volatility. All we must do is become aware of it, as if we can improve our options or our options. So in Vega, you only, like it says here, 10, 12, 13 cents, 0.13. So every 1% move, like the option will increase by 12, just by 12 cents. Okay. So depending, this is like, will tell you how much will increase your contract or your delta. So the theta section of your options table tells you what the current time effect your option has. It means time can move this option price either down by this amount. We cannot rely control time. All we do is become aware of it. It can eat our options and hurt our profits. So we need to be aware of this. Theta is the amount that is going to lose your contract for every dollar that it lost or every day. So if it says 27, your contract will decrease by 27. So you want to be, the closer The closer you are is better than out the out of the money. It's better to be closer because your contract will hold more value. Delta section of your options tell you what the current rate of change every dollar move from the underlying stock price will affect your option. For example, a delta of 50 will increase your options premium by 50 for every dollar move the underlying stock has in your favor. If you purchase an option for $3 and the underlying went up to $1, then your option will be $3.50. So this one, the delta, you need to pay attention to. If you want to get most of the gains, like it says here, 48, then every time a stock goes up $1, you get 48 cents to your contract to gain. So that's why you got to choose closer. The closer you get to the money, at the money, or in the money, the bigger the delta. As you can see, bigger the delta. So the more gains you get if the stock start going up. The gamma section of your options table tells you what the current rate of change every dollar move of the underlying stock price will affect your delta. For example, a gamma of 0.05 will increase your option delta for 0.05 for every dollar move that underlying stock has in your favor. If you purchase an option for 3 and the delta was 50 and the underlying went up for $1, then your options will be 350, but now your delta would be 55 because the gamma was 5. So therefore, if there is another increase in the underlying by $1, then your option will be worth 4.05 as the delta increased by 0.05 from the gamma. So the gamma is here. So this says 13. So this contract, if it goes $1, this 13 are going to be added up to the delta, this delta. So now this delta is going to be around 62, 48, 61. So then every dollar from then, therefore on, now it's going to be the delta for 61. So every dollar increase is going to increase $61 your contract, and on and on. So which options do we choose? As a general rule of thumb, if you're day trading or swing trading options in a short amount of time, 4 weeks and under, you should stick to the delta between 30 and 70. That will provide the perfect mix of delta, gamma, theta, given that you are correct on direction. Going to a delta of 1 isn't necessary as once you hit 1 on delta, you do not get the increasing effects of gamma. 1 delta is the max of your option can increase. So this idea of 37 delta as using the options that were either between 2 in the money or 2 out of the money. In the money just means that your strike price, it was the value of the underlying is currently or more. For example, if Apple is 150, the option strike at 150 and below will be in the money, because the options are in value on the underlying. So right now, these ones we're looking at SPY. But let's look. So for example, if you're, this is are in the money. So 143, 144 and 143 are in the money. Right now it's a 144.84. It's at the money. So this will be in the money because it's less than the underlying is right now. What 144.84. So 144 and 143, they're in the money. Those two contracts, you can pick those. They're perfect to choose if you're day trading or swing trading, or these last two, that out of the money, that first two. Those are the best 4 contracts to get. So let's say 2 out of the money will be the option strike that are not in the money yet. For example, Apple is 150 and the options you're looking at are 155 and 157.50. Well, Apple is 150 underlying price. Yeah, so if you're looking at these two, this out of the money, but the first two are the perfect ones that you need to choose for day trade. These 4, 2 in the money, 2 out the money. So at the money is 144. Let's see. Okay, so these 2 in the money, these 2 out of the money. Those are the perfect mix contracts that you need to choose. If you cannot afford those contracts, then you need to trade on other stocks that are smaller caps. So you can pick those 2 out in the money, 2 out of the money. That's the most, you're gonna get the most out of it. If their stocks start running, if you pick one of those 2 first, you're gonna get the most money out of those. And they will hold pretty good. If the stock pullbacks, they will hold the value and it will get it back as soon as it start bouncing back. When you are going longer dated options, such as 4 weeks or beyond, then you can choose lower deltas. I typically can choose my target price of the underlying stock. So in the expiration period of time, which means sometimes can be a delta of 20 or less. So this should only be used as a longer dated options. So if you want to swing something and you want to get more out of the money, so then that means that you're choosing like 1 month or more out. So it's at 27, December 27, and then you can come out and then go delta. And you can choose more out of the money, and you'll be better off. Choose this one as this one. That's for swing trade, because when the price and then the strike price you can choose as your price target. So if you're a stock that you said, okay, in 3 months or 1 month, I think Apple is going to be a 180, because you're looking at the charts and everything is telling you that will be your longer price target for the stock to move in, like in 1 month, 2 months. Then you choose the price target, the strike price at a price target. So for example, if you think it's going to get to 180 in a couple months, then you choose 3 months out and 180 strike price. That's an example. If you think it's going to get there in 3 weeks, you can get like 2 months out or 1 month out, and then you choose the strike price that you think the stock is going to be at, close or right at the money, depending on your price target. So always just only pay attention to the delta. Has to be over 30. So this 34 is good. If you're day trading, you don't look at data that much because you're gonna be in and out, right? The closer you get, the better your contracts are gonna be. So this one, if you want to day trade Apple on Monday, just get 2 out of the money or 2 in the money. I think most of us do out the money because they're cheaper. And so yeah, the first 2, I would say the third is fine too, to get the most value of it. So the first 2 are the primes to choose. We got here open interest 20,000. So that's the open interest is for the people. Is this 20,548 out of the contracts that are holding, they're buying. That 57,000 they sold or buy. We don't know until the next day. If this number goes down, that means that they sold some or they buy. Or if this number increase, so they think they're buying it. So if you're paying attention or at your stock that you always watch, you see they're buying these contracts, buying these contracts. So I think that they think they're gonna be at 145 and more because there's a lot of volume and a lot of open interest. So if this contract, if this number increase by Monday, you see this one at 40,000. So that means that we're buying it. And if you look at the chart and you see a nice pattern on Apple, and then that means that it has a good probability that it's going to go up. But always the 2 first contracts are going to be the best for day trading. But always look at the open interest too, to see how many people are in those contracts already. And the volume is a volume you don't know yet if they were selling, because sometimes you can see 20,000 here, and you see here 15,000, and they probably sold those 20,000, and then the next day it's a 5,000, and they were selling those contracts. They would get rid of them. So that's why you gotta just follow the stock, follow the option chain to see what they're buying, what they're selling, and you connect all the dots and get all your bias on whatever the stock is gonna do. If you think it's gonna be bullish and you see the contracts, they're buying it up. Let's tell you one more, let's give you one more point of confidence that the pattern that you're looking, it'll probably start running soon, you know? So yeah, so that's pretty much the first 2 contracts, either in the money, out the money, are where you're looking for day trade. Swing trade, get 4 weeks out, at least 4 weeks out, and you can choose the price target as a strike price. Okay, that's the price target could be the strike price, and you'll be totally fine. If that delta is lower, you'll be fine, because by that time you could hit your price target and those contracts are going to be at the money or in the money, and then you'll get paid there pretty good. So let's look at the chart, Apple, and then see what's the so we're looking here. Apple made a bottom here, made a double bottom, and it's currently above the 20-day and the 100-day, and above there this resistance right here that we mark. Remember, resistance becomes new support. So if this was a resistance here, came down, and now it's breaking, that will be the first price target at this SMA line, 50-day, because these SMA lines work as the average move for the stock, right? But they act as a support or resistance. So if we broke this, you see here was acting as a resistance, and now we've broken above, we came back, retested. It's pretty much as the support and resistance that we put on our stocks. The same thing. They act the same thing. But when they're above it, they're telling you that it's bullish, it bounces. So when break above, they start running to the next. So the next resistance that this could be running off, if we broke the 20-day, but then we got resistance here. You don't go and buy here because you got to see what all the resistance we got back here. We got this one right here. So this one could come here and then came back. So that's why you don't enter just because you broke this SMA line. You got to know what's behind, what was the past resistance, and make sure you clear that and you don't have anything in the way to go to your price target. So about that, we got this 50-day and this resistance appeared of 148.58. So it looks good. See here, looks good. RSI over 50. Squeeze is slowing down. Stochastic looks good. So we just need confirmation tomorrow, breaking this resistance, and the price target could be 147.05. That's a nice trade right there. Nice base down here for 20-day. Just need to clear this, and we can go all the way up to 140. We got another resistance right here. It's the same thing. So 147 could be the price target for Apple. Okay. So up here, 145 can get to 147, $2 move. So I'm gonna show you another thing about this. Okay, if you go here too, when you're trading options, you can see where are the sentiment, where are they buying more calls. It's 861,000 puts, 433,000, and your PC ratio 0.5. So it's fine. This one, they're double or bullish than bears, right? And then you have another options here. Options, times, and sales. 15, that day, there were 10,000 calls. December 17, at this time, 9:45. 10,000 calls at 290. They think that and 150 calls. So it's 10,000 times 290, they buy $2,900,000. But then they buy the same price, the strike price, but puts 10,000 at 884. It's way more. But when you see more bullishness, this could be sometimes what it is that They do that to trick the people. They do it, they cancel that and then they buy another one. You don't have to go off this ones just to trade off because they do that a lot. But just give you an example what they're buying. Like this day, they were the biggest. All the buys, sales, time, date, time, the contract, quantity, 1 or 2 contracts at the price target. I mean the price. This is the delta. And at what price they were buying it at. Like this one. These two. Oh, this one. 145. They buy when the stock was at 144.87. They buy a last minute. They buy a call. Last minute. One call. And they're probably swinging this. So if you see this, more calls than puts that day, telling you something, right? So you can go up here, look, see what's going on, get more bias on your favor, you know. So this is the option chain, then the statistics, whether more calls or puts, and then options, time and sales. You can see what options are buying out. Like bigger options like this, like huge 10,000 calls or 10,000 puts is something that you need to like look for. Sometimes they're just like day traders, banks, with a lot of money. So hopefully this video help you understanding options, help you understanding what contracts you should take. And it's simple. The 2 first out the money, the 2 first in the money are the best contracts to choose for day trade or short-term swing, like swing for 2 days, 1 week. But if you're gonna get longer swings, more than 4 weeks swings, then you could choose more out of the money with lower delta, and you can be okay. It's the only time that you should get out of the money contracts that way out of the money. But for day trade, stick to the first 2 out of the money, the first 2 in the money, and at least the delta of 30, 70, 30 to 70. The less is 30, and max is 70. And like I said, $1 is the max the contract will raise on delta, so it's not worth it, you know. So you should stick to the first 2 of the money. I think those are the more cheaper, and they're okay, the first 2. So that's why you need to choose the stock that you can trade with, that you can afford to trade. If you have a small account and you want to trade Tesla and all the big names, you're not going to be able to buy the first 2 contracts because they are expensive, like Amazon. Put Amazon here. So if you choose contract Amazon, first 2, they're going to be pretty expensive, right? And if you choose back down here, look at the delta. So small. Look at the theta. But if you get another stock that you could trade, let's say DKNG, you can afford this $100 and 75. Look at the delta. Delta is 32, 42. These are fine. These are fine to choose. So stick to the stocks that you can afford to buy the first two in the money, or the first two of the money. You can do the third one too, but typically it's better to choose the first two. See another one. Apple, I think that's a good one too. Yeah, Apple. You can choose the second one. It's good for a small account. Only buying one contract. But if you go Facebook, you see 400, 300. So if you want to get good gains and your contracts to hold better for any pullback on day trade or whatever, the first two out and the first two in the money. That's all you gotta know. For swing, it's fine to choose out the money with a delta of 21, even 14, but 20, between the 20 and up is the best for swing. Because you don't know when the stock is going to start running. But if you're sure that it's going to be a huge move, or a catalytic news out there or something, you can choose out the money and you'll get the better return, huge return, because there's going to be way more expense. The implied volatility is going to go higher in those, and then you're going to get a lot of money, more percentage gain on out of the money. But that's only when you know that a big move is coming. But if not, just stick to the first two for day trade, short-term swing, and delta 20 for swing, for longer swings with more time on your expiration. Shorter time on expiration, first two, the first four, these first four, the only options. Same goes with puts. So any question, guys, let me know. And tomorrow I'm gonna have a last class of day trade, like how to enter, how to put your stop loss on a day trade when the move is not gonna be good and you need to get out, and when you should hold if it's pulling back and you should hold and it's fine. I'm gonna be giving that class tomorrow. That's gonna be the last one for this seminary, and I hope you guys are learning something. And if I can improve anything, just let me know in my DMs. Send me any questions you guys may have. So thank you very much. Hope you enjoy it. Have a good one, guys.